everyone, welcome back to the channel, your number one source for income-oriented investing. And in today's video, I'm going to give you 5 reasons why I personally have made the decision to never ever invest in any fixed income assets, bonds, right? Anything like that, preferred shares, ever again. Well, you know what they say never, but I'm pretty sure about this one, guys. So the reason I wanted to make this video is because I currently have no more fixed income assets in my portfolio. I'm pretty much 100% equities. I'm going to give you the 5 reasons why I'm never going to touch fixed income again. I think this is important to understand now, because if you're like me, if you're a long-term income investor, you could be tempted to follow the trend, right? There's that 60-40 trend. You could be tempted about that. Fixed income has been in the investing news lately because with interest rates skyrocketing up and now starting to go down, it could be a good bet now to get into fixed income, or you'll hear that fixed income is looking more interesting now. This is my opinion, guys. Just remember, this video is my opinion. I think that's just a waste of time. It's a bunch of nonsense. And I really believe that if you're a long-term income-focused investor, you don't need fixed income at all. So let me go through the 5 reasons. Reason number 1, and definitely the most important reason, I would say the primary reason, is the terrible long-term performance that fixed income had and probably will continue to have. And I am not talking out of my butt here. Let me give you some proof, everyone. So I took a few slides from various either recent fund manager presentations. So let's look at a few of these together and I'll show you exactly what I'm talking about. This is I took this from one of Brompton's latest presentation, where you actually see in the last 10 years, all the asset classes versus the S&P 500 or equities. This would be the equities here. So you firmly see that in the entire fixed income realm, whether it's aggregate bond, high yield corporate bonds, preferred shares, emerging markets bonds, developed market bonds, senior loans, US tips, US T-bills, which is government, but everything, you could clearly see over a 10-year period how it's not even close. Look at this crappy performance here. On the left-hand side, you have the annual total return. And you could see that what's all the way at the top, it's the S&P 500, aka equities, aka businesses, stocks, right? You could see that long-term, it's not even close. Fixed income it can't even come close to the S&P 500. Let's look at the annual returns of the S&P 500 in the last 40 years. You see that the returns have been mostly positive, with an average annual return of 11.2 the last 40 years. This is not the last 10 years. This is 40 years. You could actually see some years, of course, the 2000s, when you got the internet crash. You see 2000, 2001, 2002, actually 3 years in a row with negative performance. Man, can you imagine buying and investing every single month 3 years in a row with negative performance? I would love for that to happen. Of course, you have 2008. Of course, you have the COVID. But during the COVID, it actually recovered so quickly that you see that it's still positive in 2020. But you see 2022 minus 18. So, of course, there's going to be some years are going to be negative. But the long-term average is obviously positive, 11.2% on average. Here's one taken from Michael Saylor's one of Michael Saylor's slides. This is the last 4 years. And obviously, he's trying to show how Bitcoin's outperforming. So you actually have the pyramid here of what asset has performed best. Bonds is in dead last place. Bonds are disgusting here, as you could see. Not only did it beat gold, beat it, real estate beat it, but look at the S&P 500 here, 15% in the last 4 years. Of course, the Magnificent Seven, just those 7 tech stocks, have beaten the S&P 500. And then you have Bitcoin, which has beaten everything. But again, just showing you more graphs from different sources so you believe me. And this has to be my favorite one. This is actually taken from Harvest ETFs, where he had the professor Jeremy Siegel. This was in his presentation. This is since 1802, guys. 1802. We're going back all the way. If you would have put $1 back in 1802, And again, you could see stocks completely destroyed everything. Bonds, you see here, bonds, bills, which I'm assuming is T-bills, government bonds probably, gold, the US dollar, of course, that's going to go down, right, because of inflation. So I think it's pretty obvious, you know, and if you want, we could do more, guys. We could look at the most popular bond or fixed income type assets. Of course, you have TLT, which is the long-term government bond, which is what, you know, a lot of covered call ETFs like Bond from Evolve, H Bond from Hamilton, Happy Tea from Harvest, LPay from Global X, TLTW, of course. Of course, if you put a covered call strategy, you got to remember it's still going to follow pretty much the performance of the underlying. So how did these do in the last 10 years per se? Look at TLT, gross. Look at LQD, which is investment grade corporate bonds. So bonds from or fixed income from top-notch companies, right? Reliable corporations. 2.92 average annual return in the last 10 years. What about junk bonds or just regular high yield corporate bond, the HYG ETF? 4% annual total return. We could keep going. Preferred shares. What about preferred shares? 3.99 in the last 10 years. These are giant, massive ETFs, and this is fixed income relating to the US, which performs, I believe, even higher than Canadian fixed income, emerging market fixed income, and developed markets fixed income. Then you have the aggregate bond, AGG. Aggregate, when you see that, just means several fixed income together. I mean, look at these low fees as well. Performance 1.81 on average per year. S&P 500, 13.34. So it's not even close, everyone. The performance really speaks for themselves. This is not a matter of opinion. Long-term fixed income performance is completely garbage versus equities versus stocks. All right, everyone. So reason number 2 is that covered call ETFs or the covered call strategy could literally turn equity, right? Could literally turn the S&P 500, a NASDAQ 100, a group of stocks, a sector of stocks, whatever, even a single stock, into an income style product. Right, so this is the genius of the covered call ETF strategy. If you're an income investor, you could turn equities, which are normally a growth-oriented asset class. Of course, there's dividend stocks in there, but overall equity is known for growth, a growth-type investor. You could turn equity into income with the covered call strategy while still being invested in equities, the better or higher performing asset class over the long term. So this is why I feel that income investors who invest in covered call ETFs, even though there's fixed income covered call ETFs, why bother? You could just go with the equities because that's becoming an income asset, paying you every month or every week, and you're tied to the performance of the stock market instead of the bond market. So absolutely a big reason as well. So you simply don't need it anymore as an income investor, as a long-term income investor as well. Reason number 3 is that fixed income is not tax efficient at all. And this is both in Canada and in the US. So in Canada, you know, I'm not an expert in the US side, but it's very, very similar. In Canada, when you have fixed income instruments, and of course, we're talking about your non-registered account, right? Your taxable account here. All the income you get from fixed income style or bond style securities, no matter what type it is, it's interest income. It's regular income, just like GICs. So it's all taxed like salary income, rental income. It's taxed the worst. It's taxed the worst. Whereas covered call ETFs, those premiums are taxed as capital gains, literally 50% better. They are taxed 50% better, not 10%, 50% better than interest. Not only are you getting less performance, less yield, you're getting taxed more. Reason number 4 is one argument maybe someone could have is that fixed income overall has lower volatility. But my counter argument to that is who cares? Who cares? If you're a long-term buy and hold investor like I am, you're in it for the long term. So obviously, like we saw the S&P 500 chart, some years could be bad. There could be a COVID, there could be a black swan, there could be a recession. Doesn't matter. I'm in it for the long term. And this is even the genius about the cover call strategy. You're getting paid, so you don't have to sell your share. So volatility doesn't mean anything to me. It doesn't make a difference at all in my life. At all, at all, at all. So who cares about that, right? This brings me, or transitions me, to my fifth reason, which has to do with this, right? The 60-40, right? You hear a lot about this, go 60% stocks or 60% equities and 40% in fixed income and bonds. That's just a trend, guys. It's just something, I don't know who invented that, but for a long-term investor, it really, really hurts you. It's pure garbage. It's pure nonsense. I don't believe in it. This is my opinion, guys. I'm just telling you my opinion. If you feel comfortable with the 60-40, that's fine. There's even income-oriented funds that have 60-40 split in it. Global X has them. Harvest has one. But I just feel it's not necessary. Again, if you're going to hold something long-term, why bother getting 60% of the best asset class in the world, equities, and 40% of a crappy asset class when you could just get 100% of the best one, equities? To me, it doesn't make any sense. So I think that whole 60-40 rule, it's just a dumb rule that somebody made up. It's just like that 4% fire rule. Who came up with that? It's just a trend. Doesn't mean you have to follow the trend. You got to make your own trends in life, right? So that's it for my 5 reasons of why I will never invest in fixed income ever again as a long-term income investor. Might as well just go all equities, all stocks, all the time. I don't see why you would ever want fixed income, why you would ever want a lower performing asset class. Makes absolutely no sense to me. Gone are the days where income investors have or maybe going or oriented into bonds because they provide a more reliable source of income, that dividend stocks as well. But now with the covered call ETFs, the covered call strategies, you just don't need to bother with it. So that's my opinion. What do you think about what I'm saying here? Do you agree with me? Let me know if you feel like there's the case, or you feel like fixed income does fit in your portfolio. Let me know. Let me know in your opinion, but in the comment section below. Give me a thumbs up on this video, guys. I would really appreciate it. It really helps to get the word out. And of course, take care and see you next time.